The general crisis was a period of widespread economic, social, and political unrest that occurred between the late 16th and early 18th centuries. This crisis affected multiple regions, including Europe, China, the Ottoman Empire, and parts of the Americas, and was characterized by economic downturns, famines, revolts, and population declines. Historians attribute this crisis to a combination of climate shifts, economic contractions, and political instability that collectively led to prolonged hardship for millions of people. One of the key factors contributing to the general crisis was the Little Ice Age, a period of cooler global temperatures that led to shorter growing seasons and widespread crop failures. As a result, food shortages and famines became common, leading to malnutrition and increased mortality rates. Economic instability followed, with inflation, declining tax revenues, and distributions in trade. Many governments, struggling with financial crises, resorted to higher taxation and military conflicts to maintain control, which only worsened conditions for their populations. In Europe, many countries faced severe hardship. Spain suffered economic decline due to their over-reliance on American silver, which led to inflation and financial collapse. France experienced both political and social unrest, culminating in the Fronde Civil Wars. England went through a series of conflicts, including the English Civil War, as economic difficulties fueled political discontent. The Holy Roman Empire was devastated by the 30 Years' War, which left large portions of Central Europe in ruin. Beyond Europe, other regions were also deeply affected. In China, the Ming Dynasty struggled with economic crises caused by silver shortages and agricultural decline, which contributed to its eventual collapse and the rise of the Qing Dynasty. The Ottoman Empire faced military stagnation and economic struggles as its expansion slowed and inflation took hold. In the Americas, indigenous populations suffered not only from European colonization, but also from economic disruptions, forced labor, and declining resources. The long-term consequences of the general crisis were significant, as in many countries, governments adapted by strengthening bureaucracies and centralizing power, leading to the rise of more modern states. Economically, many regions shifted towards more sustainable agricultural and trade practices, and the crisis also reshaped social structures, as labor shortages led to changes in the workforce, and widespread suffering continued to new political ideologies and movements. Ultimately, while the general crisis was a period of hardship, it also played a crucial role in shaping the modern world by forcing societies to adapt to economic and environmental challenges. The British credit crisis was a severe financial downturn that occurred in 1772 to 1773, primarily affecting Britain, but also spreading to other parts of Europe and the American colonies. The crisis was triggered by speculative lending practices, overextended credit, and economic instability, leading to the collapse of many banking institutions. This economic disaster played a crucial role in shaping financial regulation and contributed to tensions between Britain and the American colonies in the years leading up to the American Revolution. The crisis began in June of 1772, when some of Scotland's largest banks collapsed due to risky investment and overlending, had engaged in speculative trading in East India Company's stock, and suffered heavy losses. Unable to cover his debts, he fled to France, triggering a panic among creditors. As news spread, a chain reaction of bank failures ensued, first in London and Edinburgh, and then across Europe, affecting financial centers in the Netherlands, France, and beyond. The crisis was worsened by the interconnected nature of the banking system, where many institutions had overextended credit, expecting continued economic growth, and because of all of this, the economic impact was severe. In Britain, businesses that relied on easy credit found themselves unable to secure loans, leading to widespread bankruptcies and unemployment. Merchants, specifically those involved in transatlantic trade, were hit hard as liquidity dried up. The effects extended to the American colonies, where many businesses depended on credit from British banks. When British lenders demanded immediate repayment, colonial merchants and planters faced financial ruin. This increased resentment towards Britain and contributed to the growing economic grievances that would fuel revolutionary ideology. The British credit crisis also had long-term consequences for global finance. In response, Britain took steps to stabilize its economy, including reforms in banking regulations to prevent similar collapses. The crisis highlighted the dangers of speculative lending and over-leveraged financial institutions, leading to a more cautious approach to credit in following years. Additionally, the financial strain on the British economy made the government more reliant on taxation from the American colonies, worsening tensions that resulted in the American Revolution. Ultimately, The British credit crisis of 1772 was a pivotal moment in economic history. It exposed the vulnerabilities of an increasingly interconnected financial system and demonstrated how economic instability in one region could have widespread consequences. The Long Depression was a severe global economic downturn that began in 1873 and lasted until approximately 1896. It was triggered by financial crises in Europe and North America and led to prolonged stagnation, deflation, and widespread economic hardship. While some historians debate its exact duration and impact, it is widely regarded as one of the longest economic disasters in modern history. The crisis began with the Panic of 1873, a financial collapse sparked by the failure of the Vienna Stock Exchange in Austria-Hungary, which quickly spread to the United States. In the US, the collapse of J. Cook and Company, a major investment bank heavily involved in railroad speculation, caused a wave of bank failures and business closures. The rapid expansion of railroads, fueled by speculative investments, had created a financial bubble that ultimately burst, leading to widespread bankruptcies and the closure of over 100 banks. This financial turmoil triggered a prolonged economic depression marked by deflation, declining wages, and high unemployment. The Long Depression affected numerous countries, specifically those in Europe and North America. Germany and Britain, both industrial powerhouses, suffered from declining production and trade slowdowns. France, still recovering from the Franco-Prussian War, also faced economic difficulties. In the United States, the Depression led to mass unemployment, labor strikes, and social unrest as workers struggled with low wages and poor working conditions. Farmers in both the US and Europe were hit hard by falling agricultural prices, which made it difficult to repay debts and sustain their livelihoods. Many businesses, unable to secure credit, were forced to shut down, further deepening the crisis. The Long Depression forced many governments to abandon the classical liberal economic policies of the mid-19th century and shift towards protectionism, imposing tariffs to shield domestic industries from foreign competition. This move contributed to rising economic nationalism and trade disputes, and in the United States, economic hardship fueled labor movements, leading to increased unionization and violent clashes between workers and industrialists. The Depression also accelerated economic transformations as industries sought to increase efficiency and reduce cost, eventually laying the groundwork for the rapid economic expansion of the early 20th century. Although the Long Depression gradually eased by the 1890s, its effects were long-lasting, and it reshaped global trade, altered financial policies, and contributed to political and social tensions in multiple countries. The Great Depression was a severe worldwide economic crisis that began in 1929 and lasted throughout the 1930s. It was triggered by the stock market crash in the United States on October 29, 1929, known as Black Tuesday. This collapse led to a chain reaction of bank failures, business closures, and mass unemployment, affecting millions of people across the globe. The Great Depression became the most devastating economic downturn in modern history, impacting nearly every industrialized nation and many developing countries. The immediate cause of the Great Depression was the rapid decline of the US stock market, where years of speculative investment had created an unsustainable financial bubble. As stock prices plummeted, panic spread among investors, leading to widespread bank runs and financial instability. Many banks, unable to recover their loans, failed, causing further economic contraction. The crisis was worsened by declining consumer spending, reduced industrial output, and a collapse in international trade, partly due to the Smoot-Hawley tariff, which imposed high duties on imports and led to retaliatory measures from other nations. In the United States, unemployment soared to nearly 25%, leaving millions without income or basic necessities. Farmers faced plummeting crop prices and widespread foreclosures, specifically in the Midwest, where the Dust Bowl worsened their struggles. In Europe, countries already burdened by World War I debts suffered as trade declined and industries shut down. Germany, which relied heavily on American loans, experienced skyrocketing unemployment and economic collapse, contributing to political instability that helped the rise of Adolf Hitler. Britain, France, and other European nations faced economic contractions and government intervention in an attempt to stabilize their economies. In Latin America, falling demand for exports such as coffee, rubber, and minerals led to financial crises and political unrest. The Great Depression had profound and long-term consequences, and in response, governments around the world adopted new economic policies to prevent future crises. In the US, President Franklin D. Roosevelt introduced the New Deal, a series of social and economic programs designed to provide relief, recovery, and reform. These included public work projects, banking regulations, and social security measures. Globally, the Depression led to a shift away from the laissez-faire economics towards increased government intervention. The economic distress also fueled the rise of totalitarian regimes in Germany, Italy, and Japan, contributing to the outbreak of World War II. The OPEC oil price shock was a major economic crisis that occurred in two waves. First in 1973 and then in 1979, causing severe disruptions in global energy markets and economies. The crisis began when the Organization of the Petroleum Exporting Countries, abbreviated to OPEC, led by Arab nations, imposed an oil embargo in response to Western support for Israel during the Yom Kippur War of 1973. The embargo targeted countries like the United States, Canada, the United Kingdom, Japan, and the Netherlands, leading to a sharp increase in oil prices. Before the embargo, oil was relatively cheap, fueling economic growth in industrialized nations. However, as OPEC cut production and restricted exports, the price of crude oil quadrupled between 1973 and 1974, causing inflation and economic slowdowns worldwide. Gasoline shortages became common in affected countries, leading to long lines at fuel stations, rationing, and government-imposed restrictions on energy consumption. The situation worsened with the second oil shock in 1979, triggered by the Iranian Revolution, which disrupted Iran's oil production and further reduced global supply. This caused oil prices to more than double again, intensifying the crisis. The oil shock severely impacted economies worldwide, and in the United States, the cost of living soared as businesses and consumers struggled with rising energy costs. Inflation reached double digits, unemployment increased, and economic stagnation set in, leading to a period known as stagflation, which was a combination of stagnant growth and high inflation. European nations, heavily reliant on Middle Eastern oil, also faced economic downturns, while developing countries that depend on oil imports suffered from increased debts and trade imbalances. Even oil-producing nations, despite higher revenues, faced instability as fluctuating prices led to economic mismanagement and political unrest. Many Western countries began investing in alternative energy sources, increasing domestic oil production, and implementing fuel efficiency measures. The crisis also led to the rise of strategic petroleum reserves, as governments sought to protect themselves from future supply disruptions. Economically, the shocks contributed to the decline of manufacturing industries in some regions and accelerated shifts towards service-based economies. Additionally, the crisis heightened geopolitical tensions, influencing U.S. foreign policy in the Middle East for decades. The Latin American debt crisis was a severe financial and economic crisis that affected much of Latin America during the 1980s, often referred to as the Lost Decade. It was triggered by a combination of excessive borrowing, rising interest rates, and declining global economic conditions. The crisis left many Latin American nations struggling with massive debt burdens, economic stagnation, and widespread social unrest. During the 1970s, many Latin American governments borrowed heavily from international banks, specifically in the United States and Europe, to finance infrastructure projects and economic development. These loans were made available due to the abundance of petrodollars from oil exporting nations, which needed to be reinvested. Initially, this borrowing fueled economic growth, but it also led to unsustainable levels of debt. In the early 1980s, global economic conditions worsened as the US Federal Reserve raised interest rates to combat inflation. This made it significantly more expensive for Latin American countries to repay their debts, as their interest payments skyrocketed. At the same time, global commodity prices fell, reducing export revenues for these nations and making it even harder to meet financial obligations. The crisis officially began in August 1982 when Mexico announced that it could no longer service its debt, leading to panic in international financial markets. Other heavily indebted nations, including Brazil, Argentina, Chile, and Venezuela, soon faced similar difficulties. As these countries struggled to meet their debt payments, banks cut off new loans, and many Latin American countries collapsed into deep recessions. Governments were forced to implement severe measures dictated by the International Monetary Fund in exchange for financial assistance. These policies included reducing public spending, privatizing state-owned enterprises, and liberalizing trade. However, these measures often led to widespread unemployment, declining wages, and increased poverty, sparking protests and political instability across the region. Many countries suffered a lost decade of economic stagnation with minimal growth and persistent inequality. The crisis also led to shifts in economic policies, as nations moved away from protectionist and state-led development models towards free market reforms. Internationally, the crisis forced changes in how financial institutions handled sovereign debt, leading to the development of debt restructuring programs. With that being said, the Brady Plan, introduced in 1989, helped restructure debt and restore economic instability to some extent. Ultimately, the Latin American debt crisis highlighted the dangers of excessive borrowing and reliance on foreign capital. The Soviet economic depression was a prolonged period of economic decline that contributed to the collapse of the Soviet Union in 1991. It occurred primarily during the 1980s, though its roots stretch back to systemic inefficiencies in the Soviet planned economy. The crisis was driven by stagnation, declining productivity, falling oil revenues, and failed economic reforms, ultimately leading to political instability in the end of the USSR. By the 1970s, the Soviet economy had begun to slow after decades of rapid industrialization. The centrally planned system, which prioritized heavy institution and military spending over consumer goods, became increasingly inefficient. Corruption, bureaucratic inefficiencies, and a lack of innovation hampered economic growth. However, the situation worsened in the 1980s when global oil prices plummeted. The Soviet Union, heavily reliant on oil exports for hard currency, saw its revenues collapse. This made it difficult to fund both domestic programs and maintain its influence abroad. At the same time, agricultural production decreased, forcing the USSR to import grain from Western nations, adding to its economic strain. In an effort to reverse the decline, Soviet leader Mikhail Gorbachev introduced economic and political reforms under economic restructuring and openness. However, these partial market reforms created confusion, as industries were neither fully state-controlled nor truly independent. Supply chains broke down, shortages of basic goods worsened, and inflation soared. Citizens faced long lines for food and consumer goods, while wages stagnated. Many state-owned enterprises, no longer guaranteed government support, collapsed, leading to rising unemployment. Social unrest grew as living conditions deteriorated, and nationalist movements gained momentum in Soviet republics seeking independence. The weakening economy also affected the military, reducing Soviet influence in Eastern Europe. By 1989, many Soviet satellite states began transitioning away from communism, and by 1991, the Soviet Union itself dissolved. The newly independent states, including Russia, Ukraine, and the Baltic nations, faced severe economic turmoil, hyperinflation, and the difficult transition to market economies. The collapse of the Soviet economy had global implications, as the United States emerged as the world's dominant superpower, and former Soviet states struggled with economic instability for years. Russia, in particular, endured a severe financial crisis in the 1990s before stabilizing in the 2000s. The Asian financial crisis was a severe economic disaster that struck several Asian economies in 1997, leading to financial collapses, mass unemployment, and political instability. It began in Thailand and quickly spread to Indonesia, South Korea, Malaysia, and the Philippines, causing stock market crashes, currency devaluations, and widespread economic turmoil. The crisis exposed weaknesses in financial systems and raised concerns about the risks of globalized markets. The crisis was triggered by the collapse of the Thai baht in July 1997, as Thailand had maintained a fixed exchange rate, pegging the baht to the US dollar. However, excessive borrowing, real estate speculation, and an over-reliance on short-term foreign debt left the economy vulnerable. When investors lost confidence, they withdrew capital, forcing Thailand to abandon the peg and allow the baht to float freely. This led to a sharp depreciation, triggering panic in financial markets. As fear spread, other Asian currencies, including in Indonesia, Malaysia, and South Korea, also plummeted, leading to economic devastation across the region. In Indonesia, the crisis caused the collapse of businesses and banks, leading to mass layoffs and skyrocketing inflation. The cost of basic goods soared, pushing millions into poverty and triggering violent riots that ultimately led to the resignation of President Suharto. In South Korea, major conglomerates collapsed under massive debts, forcing the government to seek a record-breaking $57 billion bailout from the International Monetary Fund. Malaysia and Thailand also suffered deep recessions, with rising unemployment and political unrest. Investor confidence in emerging markets declined, leading to capital flight from other developing economies. The IMF intervened with bailout packages that required spending cuts, higher interest rates, and economic restructuring. While these measures helped stabilize currencies, they also deepened recessions and increased public anger. Some countries, like Malaysia, rejected IMF prescriptions and implemented capital controls to regain stability. In the long run, the crisis forced Asian economies to adopt stronger financial regulations and currency policies. Many countries built large foreign exchange reserves to protect against future shocks, and the crisis also highlighted flaws in the global financial system, leading to discussions on reforming international financial institutions. The dot-com bubble was a financial crisis that occurred between 1995 and 2002, peaking in 2000 when excessive speculation in internet-based companies led to a massive stock market crash. It primarily affected the United States, but its impact was felt globally, specifically in countries with emerging technology sectors. The bubble was driven by investor enthusiasm for the rapid growth of the internet and the belief that online businesses would revolutionize the economy, leading to overvaluation of technology stocks. During the 1990s, the internet became widely accessible, and companies rushed to capitalize on its potential. Investors, eager to profit from the so-called new economy, poured money into dot-com startups, many of which had little to no revenue or clear business models. Venture capitalists and stock market traders speculated heavily, inflating stock prices far beyond their actual value. The Nasdaq Composite Index, which was dominated by tech sectors, soared from around 1,000 points in 1995 to over 5,000 in March 2000. Many companies, despite lacking profitability, went public through initial public offerings and saw their stock prices skyrocket. The bubble burst in March 2000 when investor confidence began to dwindle. A series of disappointing earnings reports, combined with rising interest rates and concerns about unsustainable valuations, triggered a massive sell-off. The Nasdaq collapsed by nearly 80% between 2000 and 2002, wiping out trillions of dollars in market value. Many dot-com companies, unable to generate profits, went bankrupt, and in the United States, the bursting of the bubble led to significant job losses in the tech sector, specifically in Silicon Valley, where thousands of workers were laid off. Investors, both institutional and individual, suffered massive losses, and consumer confidence declined. The collapse also affected global markets, specifically in countries with technology-driven economies like Japan, Germany, and South Korea. Despite the immediate downturn, the dot-com bubble had some lasting positive effects, as the internet continued to grow, and surviving companies adapted, leading to the rise of tech giants like Google, Facebook, and Amazon in the following years. The crisis also led to stricter financial regulation, including the Sarbanes-Oxley Act of 2002, which aimed to improve corporate accountability. The Great Recession was a severe worldwide economic crisis that lasted from late 2007 to around 2009, though its effects persisted for years. It was triggered by the collapse of the United States housing market, which was fueled by reckless lending practices, excessive risk-taking by financial institutions, and the bursting of a housing bubble. Many banks and mortgage lenders issued subprime loans to borrowers who were unable to repay them, leading to a rise in mortgage defaults. As the housing bubble burst, financial institutions holding mortgage-backed securities suffered enormous losses, leading to the failure of major banks in September 2008. The crisis spread rapidly, causing a global financial panic and the worst economic downturn since the Great Depression. The United States was at the center of the crisis, but its effects rippled across the world. Countries with stronger financial ties to the US, including the United Kingdom, Germany, and other European nations, were hit hard, as many European banks had invested in American mortgage-backed securities and suffered significant losses. Additionally, countries such as Spain and Ireland faced severe housing market crashes similar to that of the United States. Emerging economies like China, India, and Brazil experienced slower growth as global trade declined. The crisis also led to economic instability in countries that relied on exports to the US, causing widespread financial distress. In the United States, employment rates skyrocketed, reaching 10% in 2009, with millions of people losing their jobs. Many families lost their homes due to foreclosures, wiping out personal savings and forcing people into poverty. In Europe, countries such as Greece, Spain, and Italy saw high unemployment rates and government debt crises, leading to several measures that reduced public spending and further worsened economic hardship. People across the world suffered from declining wages, increased job insecurity, and a prolonged period of economic stagnation. In response, governments implemented large-scale stimulus packages and bailouts to stabilize financial institutions. Central banks, including the Federal Reserve, slashed interest rates and engaged in quantitative easing to boost economic growth. However, The crisis also led to increased government debt, specifically in Europe, where countries like Greece required multiple bailouts. The financial industry faced new regulations, such as the Dodd-Frank Act in the US, to prevent future crises. While economies eventually recovered, income inequality widened, and distrust in financial institutions and governments grew. The European debt crisis was a severe financial and economic crisis that began in late 2009 and lasted for several years, primarily affecting countries within the Eurozone. It was triggered by excessive government debt, banking system weaknesses, and the lingering effects of the Great Recession. Several European countries, including Greece, Ireland, Portugal, Spain, and Italy, faced increased debt levels that investors feared would become unsustainable. As confidence in these nations' ability to repay their debts declined, borrowing costs soared, making it even more difficult for governments to finance their obligations. The crisis led to economic instability, mass unemployment, and harsh measures that impacted millions of people across Europe. Greece was at the center of the crisis, as it was revealed in 2009 that the government had been underreporting its debt levels for years. When the true extent of its financial problems became known, Greece lost access to financial markets and was forced to seek international bailouts from the European Union, the European Central Bank, and the International Monetary Fund. In return for these bailouts, Greece had to implement tax hikes, pension cuts, and public sector layoffs, which led to widespread protests and social unrest. Ireland and Portugal also required bailouts due to their struggling banking sectors and rising national debt. Spain and Italy faced soaring borrowing costs, and while they avoided full bailouts, they still required financial assistance and economic reforms. Unemployment rates skyrocketed, specifically in Greece and Spain, where they exceeded 25% at their peak. Youth unemployment was even more dire, with rates reaching over 50% in some areas, leading to a lost generation of workers. Many citizens faced wage cuts, pension reductions, and decreased public services, worsening poverty levels and reducing the overall quality of life. Protests, strikes, and political instability became common as public dissatisfaction grew, and the European Union introduced stricter financial regulations and closer oversight of national budgets to prevent future debt crises. Germany, the largest Eurozone economy, played a crucial role in shaping bailout policies, leading to tensions between wealthier northern European countries and struggling southern nations. The crisis also exposed flaws in the Eurozone's economic structure, highlighting the risks of a shared economy without centralized fiscal policies. While financial markets eventually stabilized, economic inequality within Europe widened, and public trust in the EU and financial institutions weakened. The COVID-19 economic crisis was a global financial downturn that began in early 2020 as a direct result of the COVID-19 pandemic. The rapid spread of the virus led governments worldwide to impose lockdowns, travel restrictions, and business closures in an effort to contain the outbreak. These measures, while necessary for public health, caused severe economic disruptions. Supply chains were disrupted, consumer demand plummeted, and entire industries such as tourism, hospitality, and retail suffered immense losses. Stock markets crashed in March 2020, and unemployment levels spiked as businesses struggled to stay afloat. The crisis became one of the worst global recessions in modern history, affecting nearly every country in the world. All major economies experienced significant contractions, but some were hit harder than others, as the United States saw its GDP shrink by 3.4% in 2020, while countries in Europe, such as the United Kingdom, Italy, and Spain, suffered even greater declines due to prolonged lockdowns. Emerging economies, including India and Brazil, faced economic slowdowns worsened by overwhelmed healthcare systems and high infection rates. Developing nations, specifically those reliant on tourism and exports, experienced sharp declines in revenue. China, where the pandemic originated, initially faced economic challenges but rebounded quickly due to strict containment measures and government stimulus programs. Unemployment skyrocketed as businesses closed or downsized, with millions losing their jobs within weeks. In the United States alone, over 20 million jobs were lost in April 2020, pushing the unemployment rate to nearly 15%. Many families struggled with food insecurity, housing instability, and mounting debt, and governments responded with emergency stimulus measures, including direct financial aid, extended unemployment benefits, and business loans. However, the crisis widened income inequality, as low-wage workers and small businesses suffered the most, while large corporations and the stock market rebounded quickly. Governments accumulated massive debt due to stimulus spending, leading to concerns about inflation and future financial stability. Supply chain disruptions contributed to rising cost of goods, leading to inflationary pressures that persisted beyond the initial crisis. Remote work and digital transformation accelerated, permanently altering the job market, and some industries, such as e-commerce and technology, thrived, while traditional retail and travel continued to struggle. The crisis exposed weaknesses in global healthcare and economic systems, prompting discussions on better pandemic preparedness. While economic recovery eventually took hold, the pandemic left lasting scars, deepening economic divides, and reshaping the global financial landscape. Thank you very much for watching this video, and if you learned something, make sure to leave a like. Comment down below your thoughts on any of the financial crises I discussed in this video, and subscribe if you would like to see more videos like this one. Thank you again, and goodbye.